We are going to be talking about the fundamental building blocks of accounting today. This is kind of the nuts and bolts. How do we actually do accounting? We're going to start by looking at something called the accounting equation, which we talked about in the previous lecture. And then we're going to actually see how we do accounting. How do we actually record all the accounting transactions, and how does it flow through the accounting cycle? Okay, so we're going to talk about the accounting cycle, journal entries that are recorded in the journal, posting the journal entries to the general ledger, and then preparing a trial balance. Okay, the first thing we want to look at is something called the accounting equation, and we're going to see through a variety of examples that all transactions fall somewhere into the accounting equation. Every transaction involves at least two accounts, double entry accounting, and there will be a lot of different combinations based on the nature of a transaction, but it's either going to involve assets or liabilities or stockholders' equity. The expanded accounting equation, which is the next slide, shows that within stockholders' equity, at this early stage in the game, we have two primary stockholders' equity accounts, and those are common stock, also called capital stock, and retained earnings. And from my previous lecture, we said that retained earnings includes three particular accounts: revenues, expenses, and dividends, what I call the RED accounts. RED, revenue, expense, dividends. So that's a good memory tool for you. Okay? Every transaction is going to fall somewhere into this accounting analysis. Now, this is not how we do accounting. This is an exercise to get you thinking about how every transaction always results in the accounting equation being in balance. Now, in my classrooms, I do this quite a bit. Here's my accounting equation with assets on the left side and liabilities plus stockholders' equity on the right side. If the left side increases, the right side has to increase. If the left side goes down, the right side has to go down. So we're always in balance. That's the key thing you have to remember. As a result of double entry accounting, we are always in balance. If we're not in balance, you made a mistake. It's that simple. Okay? And we follow these basic rules, and when we apply them consistently and accurately, we see that they work. Okay, so what we're going to do is we're going to start looking at a variety of transactions, and these are in your textbooks, not these particular examples necessarily, but we're going to look at every transaction, and we're going to see how the accounting equation remains in balance. After we've looked at the transactions, we're going to go through a separate example, and we're going to actually record journal entries, post them to the general ledger, and then prepare a trial balance. Okay. On October 1st, cash of $10,000 is invested in ABC Corporation by investors in exchange for $10,000 of common stock. Now, we can record a journal entry, and again, later on in this lecture, we will record journal entries, but right now, what I want you to think about is every transaction involves at least two accounts, and it's going to be a combination of assets, liabilities, or stockholders' equity. And remember, within stockholders' equity, it could be common stock or retained earnings. And within retained earnings, we have revenues, expenses, and dividends. Okay? So a man or a woman begins a company by taking personal money or money from their personal account, opening a business checking account, and they issue shares of stock to themselves since this is a corporation. Okay? So cash is an asset. Assets increased. Now, it's not a liability. We don't owe this money to anybody. Therefore, if we have an asset of 10 and we don't have a liability, it's got to be stockholders' equity. When we make an investment in exchange for shares of stock, we show that increase to stockholders' equity in the common stock account or capital stock account, and that's what we see in our slide here. Assets, cash in particular, increased by $10,000. Stockholders' equity increased, and we put the increase in the common stock account. Now remember, there's no such account called assets. Assets is a category. Within assets, we have cash, accounts receivable, supplies, inventory, land, building equipments, etc. We don't have an account called liabilities. It's a category. Within liabilities, we have accounts payable, unearned revenue, notes payable, wages payable, interest payable, etc. And again, stockholders' equity is not an account, it's a category. Within stockholders' equity, we have common stock, retained earnings, and of course within retained earnings, we have revenue, expense, and dividends. Okay, so here's our first transaction. Later on, we'll see what this looks like as a journal entry. Okay, so we've funded the company. We've injected money into the company, and now before we can start providing services, we typically have to buy supplies, equipment, etc. Okay, on October 1st, we borrowed some money. We needed some more money, so we borrowed $5,000 from the bank, and we signed a 3-month, 12% $5,000 note payable. We signed what's called a promissory note. We simply needed a little bit more cash to start up with, and we plan on paying this back relatively quickly. And we're going to have to pay 12% interest for 3 months. All right, so we now have $5,000 more cash. So notice we put a plus, or we increased cash. Assets increased. So if the left side increased, the right side has to increase. And we owe this money to the bank. That's a liability. We're going to put it under notes payable. A note payable is when you borrow money from a bank. An account payable is when we do transactions with a vendor, for example, buying supplies, buying inventory, paying a security guard service. Companies that provide business on a regular basis. That's an account payable. When we borrow money, it's a note payable. Okay, so our accounting equation, assets equal 15,000, and the right side, liabilities of 5 plus equity of 10, the right side has 15. We're in balance. We're always in balance. On October 2nd, ABC purchased office equipment by paying $5,000 cash to Staples Equipment Sales Company. Okay, so we paid cash, cash went down, and now we have a $5,000 piece of office equipment. Perhaps it's a fancy copy machine, for example. Okay, so one asset increased, equipment. One asset decreased, cash. Total assets stayed the same. We still have $15,000 on the left side. We have a $5,000 liability, and we have $10,000 in stockholders' equity. Okay, so this transaction involved an asset and an asset. Let's go back and look at the previous transactions. First transaction, we had an asset and stockholders' equity, cash and common stock. Second transaction, we had an asset and a liability, cash and notes payable. Third transaction, we have two assets, cash and equipment. One asset increased by 5, one asset decreased by 5. Total assets stayed the same. Next transaction. On October 2nd, ABC received $1,200 cash from Smolin. I know that guy. He's one of our clients. Okay? So, Smolin gave us $1,200, and he expects to receive service of some sort, whatever the company does, in the near future. He simply paid for the service in advance. Now, in accounting and in a future lecture, a very soon to future lecture, we're going to find out that in order for us to record revenue, we have to actually do the work. Revenue has to be earned. Well, here, the money was paid in advance. It has not yet been earned, so we can't call it revenue. Instead, we call it unearned revenue. Now, I know the word revenue is in there, but the word unearned right here tells us that it is a liability, okay, because we have an obligation to provide service in the near future. So an asset, cash, increased by $1,200, and now liabilities on the right side increased by $1,200 as well. So again, we are still in balance. Okay? Now, when we provide service, we will then transfer the $1,200 out of the liability unearned revenue and into the revenue account called service revenue, and we call that an adjusting entry, and that's in the following chapter. We'll talk more about that. Next transaction, On October 3rd, ABC received $10,000 cash from Kristen Company for advertising services performed. Okay, so we provide advertising services. That's what our business does. We have our expertise there. People hire us. We build ads for them, magazine ads, billboard ads, whatever, and they pay us. Well, this company hired us to develop an ad for them, and they paid us $10,000 cash, okay, for advertising services performed. Okay, so notice, cash increased assets, and on the right side, under stockholders' equity, we see a $10,000 increase, and we're putting it under the retained earnings umbrella, if you will, but more specifically in the revenue account, service revenue. Okay, even though it just says revenue here, we would call this service revenue. Sometimes you would call it fees earned or fees earned revenue. There are, as you'll find in accounting, there's more than one way to say the same thing, and this is just one of many examples. Okay, so cash is an asset. It increased. Service revenue, if you remember from last lecture, increases retained earnings, which is stockholders' equity. So we remain in balance. Okay, next transaction on October 3rd, ABC Corporation paid its office rent for the month of October in cash for $9,000. Excuse me, $900. Okay, so we pay rent by the month typically, and rent is simply a cost we have to incur. Now, a cost we incur to run our business, we call an expense. So we're going to call this rent expense. We know that rent expense, like all expenses, is part of retained earnings, and it reduces retained earnings. So we paid cash. Cash is an asset. It decreased. Expenses decrease retained earnings, which is stockholders' equity. Okay? So we paid cash, we record an expense, okay, and equity goes down, and we remain in balance. On October 4th, ABC Company paid $600 for a one-year insurance policy that will expire next year on September 30th. Now, when we pay for more than 1 month's worth of rent, or in this case, more than 1 month's worth of insurance, then we record an asset. We call it a prepaid expense, and this is another one of these unfortunate terms. A prepaid expense, such as prepaid insurance, prepaid rent, are assets. And so we're going to record a $600 asset. We paid cash, and so here we are. Here's my accounting equation. Now, I'm on the left side of the equation. I'm stepping back here. Cash asset went down. We recorded prepaid insurance, which is an asset, that increased. Okay, so total assets stayed the same. One asset went down by 600. One asset went up by 600. Total assets remained the same. Because we're going to get 1 year's worth of future benefit from this insurance policy. Now, each month, as a month expires, we will adjust prepaid insurance because $50, 600 divided by 12, $50 worth of insurance expires each month. And that's another adjusting entry. And so we'll record $50 of insurance expense, and we'll reduce the asset prepaid insurance by $50 month by month. Okay? Again, we'll see adjusting entries in the following lecture. On October 5th, ABC purchased a 3-month supply of advertising materials on account. I'm going to highlight these words here, on account. Whenever you see the words on account, that tells you that credit is involved. In this case, we purchased supplies on account from Aaron's Supply Company for $2,500. So supplies is an asset, so assets increased, and this is what's called a vendor. And vendors, when we owe them money, when we buy on account, accounts payable increases. Okay, so when we owe money, when we purchase on account, we're going to record an asset, supplies, and a liability, accounts payable. We owe them that money. We're going to pay that to them in the future. If we provide service to one of our clients on account, then they owe us money, and we would call that an account receivable. One of the things you have to be careful to do in the early stages is to find out what side of the transaction you're on. We're not accounting for the other guy. Now, let's just take this transaction for example. We're accounting for our business, we record a purchase of supplies and an account payable. Aaron's Supply Company would record a sale of inventory and they record an account receivable. But we are not accounting for them. Let them worry about them. We'll do our accounting. On October 20th, ABC paid a $500 dividend to their shareholders. A dividend is a distribution of capital back to the stockholders, okay? And so it's a formal transaction. Remember, we're not allowed to just informally take money out of the company for personal use, pay for personal bills with the company bank account, but we can transfer money in and we can transfer money out. And this is how we formally take money out for the stockholders. Okay, stockholders are the owners of the business. They want to take out money, they have the right to. So, we're not accounting for the stockholders' personal affairs. We're only accounting for the business. From the business's standpoint, cash decreased by $500, and we know that dividends are a reduction of stockholders' equity. So assets went down, equity went down. Okay, dividends, which are a reduction to retained earnings, reduces stockholders' equity. All right, we have one more transaction here. Employees have worked for 2 weeks, earning $4,000 in salaries, which were paid on October 26th. Okay, so we paid cash, and we record salary or wages expense. Okay, and that's a normal recurring cost of doing business. You have employees, they expect to be paid. Okay, cash went down, $4,000. Expenses reduce stockholders' equity. Now notice on the bottom here, we summarized the effect of all of these transactions. Cash, current balance $15,200, supplies $2,500, prepaid insurance $600, office equipment $5,000. Total assets equals $23,300. That's the left side. We know the right side has to equal that amount too. We have 3 liabilities: notes payable, accounts payable, and unearned service revenue. For liabilities, total looks like $8,700. And then stockholders' equity, which is comprised of common stock and retained earnings, well, we have to figure out what's in retained earnings first. And we know that revenues increase retained earnings, expenses decrease retained earnings, and dividends decrease retained earnings. So let's figure out what is in the retained earnings account at the end of this month. Revenue was $10,000, expenses were $4,900, and dividends were $500. So retained earnings would have a total of $10,000 minus $4,900 minus $500, and it looks like that's what, $5,400 in deductions. So that'll be $4,600 in retained earnings plus common stock. So total stockholders' equity $14,600, total liabilities $8,700, and when you add those two together, the right side, which is liabilities plus stockholders' equity, we have $23,300, and that's the same as assets. We are in balance, which we need to be. Okay, so this is a good exercise for you to think about how any transaction affects the accounting equation. Now, again, this is not how we do accounting. This is a conceptual exercise to get you thinking about the accounting equation, which, by the way, is our balance sheet. Balance sheet is assets, liabilities, and stockholders' equity. Okay, now we're going to talk about how do we actually do accounting. And this is where the rubber hits the road, and you have got to memorize these next concepts. A T account. I'm going to head to the board. Okay, you'll be seeing me shortly. This thing doesn't move all that fast. But a T account looks like a capital T. Okay, every account that we have gets its own separate T account, and the T accounts are collectively found in the general ledger, or we just say the ledger. Okay? So for every single account, cash, accounts receivable, supplies, inventory, land, buildings, machines, accounts payable, notes payable, you get the general idea. Each one gets its own T account. Okay? So we put the name of the account on top, and then the word debit simply means left, and the word credit means right. Many students make the mistake of thinking that credit automatically means increase and debit therefore must mean decrease. That's just not the case. The reason for this is that when we deposit money in a bank, they tell us they're going to credit our account, and that's an increase. So we think, oh, well, credit must be an increase. As we're going to find out today, what the bank is saying is technically correct, but it's from their side of the transaction, not from our side. And we have to account for the transaction from our side. Okay? So, when we say debit, it only means left. When we say credit, it means right. Any numerical dollar value that gets debited goes on the left side of the vertical line in any account. Any amount that gets credited goes on the right side. It depends upon which account we are debiting or crediting to determine whether or not that debit or credit is an increase or a decrease, and we're going to see momentarily how we figure that out. Okay? So, repeat it to yourself as many times as necessary. Debit means left, credit means right. Okay? Going to go back here. See you in a second. You'll still hear me. Okay. As previously stated, double entry accounting says every transaction affects two or more accounts, and we are always in balance. Debits must always equal credits. You have to remember that. Debits must always equal credits. All right. Notice we didn't put an account name here because we're simply illustrating a point on the PowerPoint slide that we have two debit entries, one for $10,000, one for $800. And we have one credit entry for $3,000. Now remember, in any account, if the debit's a positive, the credit's a negative, or if the credit's a positive, the debit's a negative. So they offset each other. So we have 18 on the left, we have 3,000 on the right, and whichever side has the larger amount will have the remaining or leftover balance. Notice we had 18 on the left, we had 3,000 on the right, we have a $15,000 debit balance. Another example. Notice in this example, we have a $10,000 debit, and we have two credits which total $11,000. So 11 on the right, 10,000 on the left. We have a $1,000 remaining credit balance. Okay, so again, whichever side has more will get the remaining balance since they offset. You offset your debits and credits in any account. Okay, this is in your book. And if ever there was something which warranted making flashcards for memorization purposes and study purposes, these next two slides are it. Okay, you've got to memorize this. And there's no theory, there's no technical or complex reason why we have to do it this way. It's simply how the system works. This system was created over 600 years ago by a Franciscan monk, believe it or not. And this system of double entry accounting, debits equaling credits, still works to this very day, and it's used all over the world. Okay? The system works. Notice, let's take a look at our assets first. In any asset account, whether it's cash, supplies, accounts receivable, land, building, equipment, etc., a debit to those accounts to any asset account is an increase. And a credit, therefore, is a decrease. So we say assets have a normal debit balance. Okay? I'm going to put it on the board since I don't specifically have a slide for this, and it's worth writing down. The normal balance for any account is the side, left or right, debit or credit, is the side where we put an increase to that account. It's also where we show the current balance. Okay? The normal balance for any account is the side, could be debit or credit, where we show an increase in value to that account. And it's also where we show whatever the current balance is after any given transaction. An easy way to remember it is, pardon me, wherever you see a plus sign, that's the normal balance for that account. All asset accounts have a normal debit balance. All liability accounts have a normal credit balance. And all stockholders' equity accounts, which right now we only have two, common stock and retained earnings, equity accounts have a normal credit balance. Okay, so assets, we increase with a debit and we decrease with a credit. Liabilities increase with a credit, decrease with a debit. And stockholders' equity accounts increase with a credit, decrease with a debit. Again, don't look for any philosophical meaning here. There isn't any. You simply have to memorize this. So just keep repeating it to yourself until it's ingrained in your mind. Okay, I'm going to head back to the computer. Okay, now, using the expanded accounting equation under stockholders' equity, we also have to analyze revenues, expenses, and dividends. Now, my slide does not include dividends, but we will talk about it. Expenses. Notice when we record an expense, and write this down, commit this to memory. Whenever we have an expense, whenever we incur an expense, we debit the expense. Rarely do we ever credit an expense account. We do in what's called the closing journal entries, which we'll see in a future lecture. But whenever we incur an expense, we debit the expense account. Revenue, whenever we earn revenue, when we record revenue because we provided a service to our customers, we always credit revenue. We rarely debit revenue except in closing entries, but we're not at the closing entry point now. Okay, so don't even worry about closing entries. Whenever we earn revenue, we provide work for somebody or service, we credit the revenue account. Okay? And I'm going to go back to the board here for a moment. The dividend account, which is part of stockholders' equity, has a normal debit balance. So again, commit these to memory. Expenses have a normal debit balance. Dividends have a normal debit balance. Revenue has a normal credit balance. I know at first it seems a little bit inconsistent given that expenses are part of stockholders' equity. I will try to clarify that as we go along. Okay, but do yourself a favor and commit these normal balances. Wherever you see the plus sign, that's the normal balance for an account. So cash has a normal debit balance because it's an asset. Accounts payable has a normal credit balance because it's a liability. Common stock has a normal credit balance. Service revenue has a normal credit balance. Rent expense has a debit balance. Wage expense has a normal debit balance. The dividend account has a normal debit balance. I'm going to go back to the computer. Okay, so you will have to commit this to memory. You'll be well served to do so. What we're going to do is we're going to look at another series of transactions, and we're going to actually start recording journal entries. Now, what I'm going to suggest that you do is when you go back and look at these slides, I'm going to go back 2 slides. Make that, well, considerably, there we go. So this is slide 13. Sorry about that. This is a summary of all the transactions we talked about earlier. I'm going to suggest that after I've gone through how we record journal entries, you record the journal entries for these transactions on your own, and then post them to the general ledger T accounts and prepare a trial balance, which is exactly what we're going to do now with another set of transactions. Okay, so I'm going to get to the current slide. Okay, I hope you can read this. I'll hit the zoom in a couple of times. And it says, ABC Architects Incorporated as licensed architects on April 1st, 2010. During the first month of operations of the business, these events and transactions occurred. So what we're going to do is we're going to record all these journal entries, and once we're done recording the journal entries, we're going to post them to the T accounts in the ledger. Okay, so I'm going to go back to the board here. Whenever we record a journal entry, the proper, and I'm going to abbreviate JE for journal entry, format, whenever we record a journal entry, put the date, and whichever account is going to be debited is listed first. And then we record the amount that gets debited. So you always put your debits first in a journal entry. Doesn't matter what account it is. If it gets debited, it goes first. Underneath the accounts that have been debited, we would put the account or accounts to be credited. And we put the dollar amount in the credit column. Now notice, I indented a little bit, which is a good idea. The account to be debited always goes first. Underneath it, any accounts to be credited. A journal entry has to have at least 2 accounts. It can have more than 2 accounts. You can have 2 or 3 debits and 1 credit, or 1 debit and 2 or 3 credits. That's fine, but remember, your debits must equal your credits. So if you got 3 debits and 1 credit, add up the debits, they have to equal whatever the amount credited was. Debits must always equal credits. Okay, so now we're going to look at the transactions on the board, one by one, and we're going to record these journal entries. So hopefully you wrote that down or took note. This is the proper journal entry format. We're going to start actually recording journal entries. First journal entry. Stockholders invested $15,000 cash in exchange for common stock of the corporation. April 1st, so I'm going to debit cash for $15,000, and underneath it and indented a little bit, I'm going to credit common stock. Now, what I think would be a good idea for you is to have all of your T accounts with the pluses and the minuses, the previous slides that we saw. You should have that in front of you until it's properly memorized. And you will see that anytime cash is increased, we have to debit. Now let me go back to my comment I made earlier. When you go to the bank and you deposit money, they tell you that they're going to credit your account. And so that's why a lot of people think, well, anytime you credit something, it's an increase. And that's not true. From the bank's standpoint, remember, the bank is accounting for the bank. They're not accounting for you. they do keep track of your records, but from the bank's accounting standpoint, when you deposit money in the bank, that's a liability. Your deposit account is a liability to the bank. And if you look at your T accounts, you will notice that a liability, such as a deposit account, has a normal credit balance. So when their liability to you increases as a result of you depositing money, they say they'll credit your account to show you that they're recognizing that the liability to you has increased, since you can withdraw that money anytime you want. Now let's take this concept a little further. You get a debit card, and you go to the ATM with your debit card. When you withdraw money with the debit card, you're taking money out of your account. From your standpoint, cash should be credited since it's going down. From the bank standpoint, your account, your deposit account, which is a liability to them, they're going to debit it to reduce the liability. Okay, so what they're telling you is not incorrect. It's simply they're talking accounting from their standpoint, from their side of the transaction. But now that you're in an accounting class, you have to account for it from your side of the transaction. So when we deposit money in the bank, even though they're crediting it, let them do whatever they want, we have to debit cash, and we credit common stock. That's our first journal entry. Second transaction says we hired a secretary at a salary of $375 per week, payable monthly. Now this is a necessary and important event in any business, but this is not an accounting transaction. Even though they're going to pay them $375 a week, that person has not yet worked. They simply had an interview. They said, congratulations, you're hired. You start next week. That person changes their mind and never shows up. They're not going to get paid. So at the moment they got hired, even though it's a business event, it's not an accounting transaction. There's nothing to account for yet. Now, once they've worked a week, then we'll record wage expense or salary expense, and we'll see that a little further down. Third transaction, on April 2nd, we paid office rent for the month $900. Okay, so April 2nd, I'm going to debit rent expense for $900, and I'm going to credit cash for $900. Okay, so we spent money. We spent cash. Cash is an asset. We now have less cash as a result. Our cash went down. Okay, so we credited cash. And from an accounting equation standpoint, cash asset decreased, rent expense decreased stockholders' equity. April 3rd, we purchased architectural supplies on account. There's that key term again. Credit was involved. On account from XYZ Company for $1,000. I'm going to have to write a little bit smaller since I got to make sure I can squeeze all my transactions here. So on April 3rd, I'm going to debit supplies for $1,000. And I'm going to credit, and I'll abbreviate, accounts payable for $1,000. Okay? Think accounting equation for a moment. Supplies is an asset, it increased. Accounts payable is a liability, it increased. We're still in balance. Okay? But when you go to your normal balance chart, which we saw a few slides ago, when an asset, supplies is an asset, when an asset increases, we debit it. Accounts payable is a liability. When a liability increases, we credit it. So we debit supplies, always put the debit first. Underneath it, put the account to be credited, accounts payable in this case, and debits on the left, credits on the right. Now, if this were a bookkeeping class, we offer Accounting 100 here at Citrus, you would put a little one-sentence description underneath each journal entry. Okay, but my focus here is not so much on bookkeeping as it's on the concepts of how do we actually do accounting. So for my class, if I ask you to prepare journal entries on an exam, this is sufficient. I'll briefly mention this post-reference column, posting reference column, which is really another bookkeeping issue, but I'll mention it briefly. April 10th, we completed blueprints on a carport and billed the client $1,500 for services. Okay, another way we could have said this is that we completed blueprints and provided service on account to our clients. We billed them. They have not yet paid us. We provided service to them. Once we finish the job, we can then recognize the revenue, and since they haven't paid us yet, we're going to record an account receivable since our client owes us money. So April 10th, I'm going to debit accounts receivable. I'm going to abbreviate. Okay, and this was for $1,500. And I'm going to credit service revenue, also called fees earned, $1,500. Okay? Now you have your T accounts in front of you, I presume, and you're analyzing to make sure that when accounts increase or decrease, we're putting them on the appropriate side based on where the pluses and the minuses are in the T account. Okay, I believe we're back. And we were on the transaction on April 11th. Now I'm probably going to run out of board space here. We received a $500 cash advance from J. Smith to design a new home. So they're paying us money in advance. I received the money, but I haven't done any work yet, so I can't call that service revenue. But I have to account for it. My assets increased cash, so instead I'm going to call this unearned revenue, and as we talked about previously, unearned revenue is a liability. Okay, so I received cash. So I'm going to debit cash for $500, and I'm going to credit unearned revenue for $500. Again, this is a liability. Assets increased, so we debited them. Liabilities, unearned revenue, increased, we credit them. Okay? On April 20th, we received $2,300 cash for services completed and delivered to M. Lockridge. Okay, so we received cash, $2,300, so I'm going to debit cash, $2,300, and I'm going to credit service revenue. Service revenue, $2,300. I did the work. The work's complete. They paid me. It's not a liability. It's my money. That's why I'm in business. So cash increased, assets. Service revenue increased. And notice we always credit revenue. And that increases stockholders' equity. On the 30th, paid the secretary for the month for $1,500. So I'm going to debit wage expense, or I could put salary expense, or even payroll expense. We have a little flexibility there. Debit $1,500, and I'm going to credit cash for $1,500 since I paid them their wages or their salary. Okay, so cash decreased. Cash is an asset. When an asset decreases, we credit it. Wage expense. We always debit an expense, and we know an expense reduces stockholders' equity. Last transaction, I'm going to stuff it in there. On the 30th, we paid $300 to Citrus Company for accounts payable due. Now, let's see. I paid an account payable, so April 30th. So my liabilities, accounts payable, decreased, and I paid cash. So I'm going to credit cash. And this was for $300. So debit accounts payable, $300. Credit cash for $300. Hopefully you can see that. Okay, and you can practice this and the previous example on your own preparing journal entries. And the next thing we're going to do is, now that we have our journal entries recorded in the journal, the next thing we're going to do is we're going to post the journal entries to the T accounts, which are in the general ledger. The accounting cycle, step one, analyze transactions, and record journal entries in the journal. This is the journal. Step 2, post the journal entries. And the word post simply means transfer. And think of it this way. For each journal entry, we're going to split the debit and the credit. The debit's going to go to one account, to one T account. The credit's going to go to another T account. I'm going to now transfer to this overhead projector. Okay, so on the slide, we have all the T accounts. This collectively, all these T accounts are found in the ledger or the general ledger. Now, what we're going to do is, one by one, each journal entry we're going to post from the journal to the ledger. Transaction 1. April 1st, we debited cash, credited common stock. So to post this journal entry, I'm going to debit cash, and I'm going to credit common stock. Now, in the chapter, you read that each company establishes a chart of accounts. And a chart of accounts assigns a number. It's like an index or a table of contents. Each account gets its own separate number. So we know where to find all the various accounts, because you got to bear in mind there's some very big companies out there, and they have thousands and thousands of different accounts. You can't memorize it. Okay, so all assets, for example, might begin with the letter A or the number 1. So cash might be 10010, and accounts receivable might be 10020. All liabilities might begin with the letter B or the number 2, so accounts payable might be 20010, unearned revenue 20020, or whatever numbering system or classification system you come up with, as long as it's used in a consistent fashion and your people understand it. That's the main thing. Okay? Now, we don't have a chart of accounts here in this example. This is a very simple example. But I've just posted the first journal entry. Now, I'm going to appear back on your screen for a moment. Again, in Accounting 100 or whatever bookkeeping class you may have taken, this is where the post-reference column comes into play. And again, in this class, I'm not going to test you on the post-reference column, since that's a bookkeeping issue. But what this tells us is, once I posted this journal entry to the T accounts, if cash were account 101, I would put 101 here. If common stock were account 301, I would put 301 here. And that tells me this journal entry has been posted to the ledger. Now, on the ledger, next to cash, which would have 101 next to it, next to each individual entry, for example, the 15,000, I would put J1 for journal page number 1. And I do the same thing for common stock. Next to 15,000, I would put J1, and that tells me that those two entries came from page 1 of the journal. So if I need to research this transaction for whatever reason, I would go to J1. This is my first page in the journal. I'd look for a $15,000 transaction, and I should be able to find it pretty easily. So that's what post-referencing does. It connects or cross-references the journal to the ledger and the ledger to the journal. But that's not really our focus here, and hopefully that made sense to you. If not, don't worry about it. Okay, our next journal entry, debit rent expense, credit cash. I'm going to disappear. To post, I go to my rent expense account, and I'm going to debit 900, and I'm going to credit cash for 900. Okay, we just posted the second journal entry. Debit rent expense, credit cash. Very straightforward. Third journal entry. I see a debit to supplies for 1,000, credit to accounts payable for 1,000. So I'm going to debit supplies for 1,000, and I'm going to credit accounts payable for 1,000. And boom, I've just posted the journal entry. Fourth journal entry, debit accounts receivable, credit service revenue for 1,500. So to post, I'm going to debit accounts receivable, credit service revenue, and I've just posted. Next journal entry, debit cash 500, credit unearned revenue 500. Okay, so debit cash for 500 and credit unearned revenue for 500. Next journal entry, I see a debit to cash for I think 2,300. I didn't line it up terribly well, did I? Debit cash 2,300. No, yeah, debit cash 2,300. Credit service revenue for 2,300. So debit cash, credit service revenue 2,300. Next journal entry, debit wage expense 1,500, credit cash 1,500. So I put salary expense here. Salary expense, wage expense, consider it one and the same. I'll put wage or salary expense. And that was what, 1,500. Credit cash for 1,500. And then the last journal entry was we paid a vendor on account. We previously owed them money, and now we're paying them $300. So I'm going to reduce the liability for 300, and I'm going to credit cash for 300. And that's my last transaction. I've just posted every transaction, every journal entry from the journal to the T accounts in the ledger. Okay? In review, first thing we do is we analyze a transaction. We record a journal entry in the journal. That's step one of the accounting cycle. Step two would be we post the journal entry, which means we split the debit and the credit to the various T accounts in the general ledger. And we've just done that right here. The third step would be at the end of the month, for example, I'm going to prepare a trial balance. Now we're going to do this on the board. I'm going to erase the journal entries, and I'm going to put a trial balance on the board. And we'll talk about the trial balance here. This is the third step in the accounting cycle. Okay. This is ABC Company trial balance. And we'll say December, well, I don't even know what the month was, December 31st, 2009, whatever it was. Okay, the order, and I'll put them over here, the order of the accounts on any trial balance is we put assets first, then liabilities, then our stockholders' equity accounts. Okay, and I'm going to put in parentheses, including dividends. I'll get out of your way in a second. Then revenue accounts, and then expense accounts. Okay, so this is the order of accounts on a trial balance. Okay, so we have our T account still up on the board. I have to figure out what's the ending balance in these accounts. Now, cash, which is always a busy account, we have a total of 15,000 plus 500 plus 2,300 for debits. We've got 900 plus 15 plus 300 for credits. You should add both of them up, and you'll see that our ending balance is 15,100. And I'll just double underscore that. Accounts receivable, ending balance, supplies. We have 1,000 credit, 300 debit. That leaves a 700 debit balance in accounts payable. Unearned revenue, common stock, service revenue. Remember, we always credit revenues. Whenever we earn revenue, we credit them. 3,800 ending balance. Wage expense. Expenses always have a debit balance. Okay, and these are my ending balances. So I'm going to create my trial balance, cash. I'll put debits, credits. Here's cash. Cash is an asset, has a normal debit balance, 15,100. Accounts receivable, 1,500. Supplies, 1,000. That's it for our assets. Then we have two liabilities. We have accounts payable, and that had a $700 credit balance, and we had unearned revenue, And that has a $500 balance. Our next account is common stock. And that has a $15,000 balance. This must be our first month in operation since I don't see retained earnings. So remember what we said from last lecture. Beginning retained earnings for the very first period is 0. We'll keep that in mind. Okay, service revenue, $3,800. Then we have wage expense. That is $1,500 debit. And last, we have rent expense for for $900. Okay, and here comes the moment of truth, the big test. Do our debits equal our credits? And if all went well, and you should be adding and subtracting up at home, we should see that we have $20,000 on the debit side and $20,000 on the credit side. So we're in balance, and that's the purpose of a trial balance. This is not a financial statement. This is a worksheet we use to make sure that we didn't make any posting entries or journal entry mistakes when we were recording the journal entries. Now, the good news is the vast majority of businesses out there have computerized accounting systems, and you're really not going to have human error providing that the program works as it's supposed to work, because it takes away a lot of the human error when you have a computerized accounting system or accounting information system. Okay, but the trial balance is still important to see that debits equal credits. And if the debits equal credits and we look it over and everything looks pretty well, notice that we listed our assets, then liabilities, equity, revenues, and expenses. From the trial balance, I will then prepare my financial statements. And I'm going to let you do that on your own, but let's just verbally we'll talk about it. I'm not going to do it on the board, but you can do this. From the trial balance, first we prepare the income statement. That will be my service revenues of $3,800 minus wage expense minus rent expense, and that looks like revenue of $3,800 minus expense of $2,400 gives me net income of $1,400. So there's my income statement. Second financial statement we prepare, retained earnings statement. Remember what I said, if this is our first month in operations or first period in operations, beginning retained earnings is 0 plus net income, which is from the income statement, which we said was $1,400, minus dividends. Now, we didn't have any dividends in this example. If we had seen a dividend like we did in the earlier example, you would debit dividends, credit cash for the journal entry. We would subtract dividends. So my retained earnings statement, I have beginning retained earnings plus net income from the income statement minus dividends, in this case it's 0. Ending retained earnings is $1,400. Now that we have ending retained earnings, we prepare the balance sheet, which is my assets, my liabilities, and my stockholders' equity. Cash, accounts receivable, supplies, those are my assets. My assets total $17,600, but go see for yourself. My liabilities, accounts payable unearned revenue, is $1,200 in total. And my stockholders' equity, common stock $15,000, and retained earnings $1,400. Total stockholders' equity, common stock plus retained earnings, is $16,400. Liabilities of $1,200 plus stockholders' equity of $16,400 equals $17,600, which is what my assets equal. Again, you should practice that. You should be able to construct the 3 financial statements from the trial balance. Okay, that is lecture number 2.